with all of you. Thanks for joining us wherever you're joining from today. It's hard to believe that we're already halfway through the third quarter of the year. I don't know where the time has gone, but here we are. And we're making our way through the year, and there are some green shoots in the mortgage industry, which is good. And hopefully you guys are seeing some uptick in volume and seeing some positives here as we get through the year. Anyway, before we start, I just want to share a couple housekeeping items. We have a great session today that we hope you'll find valuable. I wanted to just orient you a little bit on the platform that you've all joined and are viewing this through today, just so that you can use it effectively. It is totally interactive on your screen, so you can adjust the sizes of the different components of the dashboard. You can change those, adjust them. Any of the questions that you have during the webinar, since you're all on mute, those can be submitted through the question portion of your dashboard on the bottom right of that platform. We encourage you to submit any questions that you have throughout. We'll do our best to respond to them as we go along. Those that we don't get to, we'll follow up with you afterwards. There is also going to be a survey. You can fill that out at any time during this webinar, or you could fill it out at the end as well. And then also, for those of you that are seeking CPE credit on this webinar, you will have to fill out and answer all 4 of the questions, the poll questions that will pop up during the webinar. So make sure, if you're looking for CPE credit, that you answer those questions. The CPE certificates will go out within the next couple weeks. Also, so you know, the webinar is being recorded, and the recording will be available within the next couple days and sent out to everyone. Also, at any point during the presentation or during the webinar, you can download the slides on the left-hand side of your screen. And you can do that during or after the webinar, so that you have a copy of the slide deck, if you would like to have a copy of the slide deck. But as I said, the recording will be sent out shortly, as will CPE certificates. So with that out of the way, we'll go ahead and dive in, and we'll highlight a couple things here that we'll be covering in our agenda. So as usual, we are going to present the results of the quarterly benchmarking data from our Fannie Mae Select benchmarking platform. We are also going to spend some time going through some of the key relevant elements of the big, beautiful tax bill that passed and was signed into law recently. And then we're just going to briefly touch on some updates from Fannie Mae related to some cybersecurity requirements, to make sure that you are all aware. Those are going into effect as we speak, with some requirements that need to be met before the end of the year. And so with that, I just want to introduce our presenters today. Most of you are probably familiar with Tyler House. He has been doing these every quarter for some time now. Tyler leads our data analytics and benchmarking practice here at Fannie Mae. He'll be presenting the results of the quarterly benchmarking survey. And then we have 2 partners from our mortgage banking tax team, Gina Jackson and Jake Lawrence, who will be tag teaming the presentation on the big, beautiful bill. So with that, I'll turn it over to Tyler. And again, if you have questions throughout, I just encourage you to submit them at the bottom right of your screen, and we'll take them as they come and respond to as many of them as we can throughout. So again, thank you for joining. And with that, I'll hand it over to Tyler.
Thanks, Nathan. I'm excited to talk about, the Q2 results, but Before we jump in there, we got to do our poll question. So here's the first poll question. What technology and automation investments are you expecting to make over the next few years relative to the last few years? And so I was actually looking at our peer group data this morning just to see what the spend has looked like over really since 2012 with technology and equipment. And it's really been up and to the right. On an absolute basis, on a dollar basis, we've seen that even on a per FTE, so a per headcount basis, has been up to the right. So that's clearly, been a trend, over the last 15 years or so. With all the advances that we're seeing in technology, with AI, all the capabilities we're seeing there, this might be a trend that we continue to see, maybe at a more elevated rate. But very curious to hear what everyone else, what the temperature is for the attendees on the webinar. And so make sure you get those answers in. Remember, you got to submit all four to get your CPE credit. No right answers, but you got to submit. So I think with that, we'll advance to the next slide and check out a few results here. And here we go. So this is exactly in line with what I would have expected. I think first, let's just highlight 0%. No one in the room thinks it'll be less than what we've seen. In the majority think it's going to be more, and maybe about 4 out of 10 think it's going to be about the same. I think I'm in your camp. I think that we're probably only going to see a technology spend increase over time. Obviously we're still in the early stages of AI, but we'll definitely see how that develops. So thank you for participating in that poll question here. So now let's shift gears a little bit and just talk about the results from Ritchie Mae Select, particularly from Q2. So as a reminder for those of you who may not be super familiar with this program, it is a benchmarking, a quarterly financial benchmarking. We've got operational data in here as well. It's designed for IMBs. There's about 70 IMBs across the nation that participate. We do also have some subs of banks that participate as well, but it's primarily focused on IMBs, and that's the source of the data here. And so let's jump in to our waterfall. In this waterfall, we're really comparing Q1 pre-tax net income versus Q2 pre-tax net income. And so on that far left side, we see that Q1 was a minus 10 basis points, and this is basis points of total origination volume. Obviously, there's some servicing activity included here, but it's really from that perspective of origination. And so, in Q1, about 50% of lenders were actually positive, but the average was negative just because we had some larger losses from a handful of lenders. And as we fast forward to Q2, we see that that's a positive 19 basis points. So a nice 30 basis point pickup there. 76% of lenders were positive. That's a little bit down from what we saw last year, Q2. Last year, it was about 82%. But we're still seeing modest improvement if we compare that percentage in 2025 to the previous Q2s in 23 and 22. So definitely some positive momentum here. And then let's just talk a little bit about the different elements that get us from a minus 10 to a positive 19. So first, we got servicing. So there's really not a lot to talk about for servicing this quarter. Not a big movement in fair values or adjustments. Not a ton of portfolios that we're seeing being sold. Definitely a little bit of activity, but not a lot. So very little impact on pre-tax earnings, pretty much the same as last quarter. But if we move a little bit further along this chart and we look at secondary and pipeline, so we actually see a 40 basis point bad guy for these two items combined. And now these, for secondary, for the 18 basis point decrease, that's probably a little bit misleading. I think if we look back to Q1, we actually saw about a 30 basis point increase in margins. So we had a nice surge, and we're really just giving 18 basis points back. The average margin on a per loan basis for Q2 was $10,600, and apart from Q1, that's the highest margin we've really seen since 2022. So I think margins are in a healthy spot, and this is really more of a reflection of kind of a correction from Q1. Now, the pipeline is a little bit interesting that we have such a large decrease or comparative decrease from one quarter to the next. As we all know, that in Q1, the pipeline usually has a pretty significant gain just simply because pipeline amounts at 3/31 at the end of March are almost always higher than they are at the end of December. But then usually we get into Q2, and in particular in a purchase market, and we still see that the pipeline's growing And so we're used to seeing a little bit of a gain there, but what we're actually seeing is that in Q1, the pipeline had a P&L gain of 18 basis points, but we had a minus 4 basis points, so a 4 basis points loss in Q2 related to the pipeline. And that's a little bit unusual for Q2, especially as we're seeing pipelines continue to grow during Q2 and into Q3. But sometimes that can be driven just by market volatility at the beginning or the end of a quarter. So moving on from margins, we could take a look at personnel. So for personnel, we kind of look at personnel in two different ways. So we're going to look at like variable costs for personnel, which we're focusing primarily on sales and then even fulfillment. But otherwise, the 13 basis point decrease here is really going to be related to what we're, for lack of a better term, kind of our fixed personnel costs. We kind of define that, as anything after post-closing. So you've got, QC, secondary, marketing, accounting, IT, all those corporate traditional functions. And what we're seeing is that there's been 11% increase in absolute dollars quarter over quarter in spend here related to compensation and benefits. Part of that's going to be due to, I think, raises, and part of it's going to be due to adding new staff in this group. We actually saw a 5% increase in headcount during Q2 related to those fixed corporate type of roles. So, certainly I think as we look at this information, I think what we're seeing is some lenders, who may have kind of held the brakes on adding some staffing where they might have needed it related to some of these corporate functions are given the green light here. We're going to have a decent, Q2. We're starting to see things thaw out. So we're not going to hold off on some of those other items that we want to hire on for. For OpEx expense, it's pretty much flat. Not really anything to talk about here. Looks like lenders are really holding budgets consistent with last quarter. That's not necessarily out of the expectation. But really the big bar, the big mover here is going to be origination volume, and that we're counting 80 basis points of pre-tax net income really related to origination volume. For the quarter, there's a 45% increase in volume, which is not necessarily out of line or much higher than what we've typically seen from Q1 to Q2. And the last two quarters, it ranged from 40 to 43%. So we're in that ballpark. But I think the real story with volume is really when you look at the full year. I think Q1 volume was a little bit unseasonably high for Q1, and then we got a 45% increase on top of that. And so that brings us really to have a 20% increase in volume year over year through the first 6 months of 2025. And that's, that's a very positive story that we're seeing so far during the year. And, I've mentioned this on previous webinars, but really where the economics seem to be for independents is that profitability is going where volume is going. If we're able to see some more volume, I think we're going to see profitability follow. But that seems to be the trend. And, that's not a terrible trend given the recent things we're seeing in the industry wide as we continue to see a volume inch up. And I think we can also see some of those trends in this chart here. So this page, we're looking at year over year trends. In the left-hand side, this is the percent of lenders with a positive net production income. And as a reminder, net production income different than pre-tax net income in the sense that net production income is isolating origination platform profitability. So it doesn't include servicing activity. And then on the right-hand side of this page, we're looking at really all the key KPIs for net production income and how Q2 is trending this year versus the previous years. So what we can see here is every one of these measures is positive, right? We're seeing positive trends over each and every single category. Again, I think the big story is going to be volume, right? We've got 19% increase in volume over last year and a 17% increase in units. So those are all great. We're continuing to see net production income as a whole increase as we went from minus 31 to 10 basis points now to 16 basis points in the second quarter. The one item that I think is a little bit interesting here to me, that we are seeing technically, we're seeing improved performance, but maybe not by a significant margin, is really going to be in production costs. So if you look at that, we're really hovering around 11,700. We 11,800 in 24, and then back to 11,700 in 2025. So we're seeing some improvement year over year. But really, it seems like we're almost bottoming out at this 11,700 number. And, you know, it's hard to say. I think if we're going to see improvements in that as the industry continues to bring on more volume, you know, maybe another 20% next year. This time we start to break that barrier and see, you know, costs come down a little bit. But whatever it is, it seems to be this is kind of where we bottom out, you know, during Q2, which tends to be one of our, you know, higher production numbers or more profitable quarters throughout the year. So overall, you know, some good signs. We can see good signs with the percent of lenders that are positive on the NPI. It continues to improve. And so I feel encouraged, and, you know, not only through Q2, but also through what we can see in the third quarter in terms of kind of the top of funnel trends. I'm encouraged as well. So if I look at application volume, which is here on the left-hand side, and then we've got lock volume on the right-hand side, we're seeing, you know, very similar trend lines to last year, but applications in particular are about 10 to 15% higher in really each and every month that we look at in 2025 versus last year. Locks are showing kind of a similar trend to that, but it does seem like we're getting a much larger boost really in August and July, where we see, you know, a little bit of a surge in lock volume. Now, this is lock volume through August 20th. We don't have the full month here, so it could be a little bit elevated with some of the ways that the business days work out. But at any rate, we're continuing to see, you know, the top of funnel pipeline grow throughout the year. And, you know, there's definitely, you know, seems like we could finish off the year on a good note. I know that the MBA is forecasting about 5.7 million loans for the year, and it does seem like we're right on track with that. And, you know, that's an improvement over last year. It's an improvement upon the year before. But aside from those 2 years, 5.7 million is actually it's actually the lowest number of units we've seen, except for 2014, which was 5.4 million units. So I think I'm encouraged by a lot of the signs we're seeing. You know, if you can be profitable in 2025 at 5.7 million units for the industry, I think that's a really good sign, because I think there's more recovery to come. At least I hope so. We never know exactly what's around the corner, but it does seem like things can get better, no doubt. With that takes us to our next poll question. So this poll question, you know, in lines with kind of those you know, questions I was raising about profitability for the year. We're just curious what everyone else's temperature is on profitability. Are you expecting to have a profitable year this year? Really simple: yes, no, or uncertain. These are anonymous answers. There's not a right answer. You just got to participate in order to get your CPE credit. But while you fill that out, I'll just put a couple numbers around what we're seeing year to date. But on a pre-tax net income basis through the first half of the year, the average was 7 basis points. 2 and 3 lenders, so 67% of lenders, are positive, and would be very curious to see, you know, what the temperature is for the rest of the year. Are we going to hold on? Are we going to see, you know, volume remain high enough so that we can be profitable by 12/31? Let's take a look at what everyone else thinks. And I like it. This is great. You know, there's a lot of lenders that we work with. They're all optimists. You got to be an optimist in this industry. And so, you know, 70% think they're going to be profitable. And I tend to agree with you. I think there's a good chance there. And then, you know, 25% are uncertain, and 5% are saying no. So, you know, I think that's pretty optimistic. And you know, anytime we're talking about, you know, profits or income, we also want to consider the tax implications, right? But I'm not going to talk at all about that. I think we should bring in the experts here. And so I'm going to hand it over to Jake and Gina to really talk to that.
Hey, thank you, Tyler. Good afternoon, folks. Appreciate your feedback on that poll question. I think based on the responses, I think this is a good opportunity for Gina and I to just share with you some information about the One Big Beautiful tax bill that was passed back in July. The bill was, I believe, over 800 pages in length, and of the 800 pages, I think 400 plus of those pages related to changes to the tax law. So I think our goal on this next portion of the webinar is to just talk with you high level about some of the impacts and things that were changed or modified with that bill that may have an impact on the tax liability of the mortgage companies. So with that, I'm going to turn it over to Gina to get us kicked off and quickly move through our agenda and where we're going to take you guys related to the One Big Beautiful tax bill.
Thanks, Jake. Appreciate that. So just for everyone's understanding, this, as Jake mentioned, is really just supposed to be sort of a high-level discussion. There's a lot of meat involved in this act. So we'll try to move through this as quickly as we can. We'll hold questions probably for the end just because there is a lot of content to get through. So with that being said, I wanted to mention that when I refer in the next coming slides to current law, I'm really referring to kind of Tax Cuts and Jobs Act, most recent law. And when I say the act, that's really referring kind of to the new OBBA, or One Big Beautiful Bill Act. That's just for simplicity so that we can kind of compare current law to what's changed. So what we'll cover today, here are the entity level provisions that we thought would be most impactful for our lenders. And so, we'll touch on, gosh, there's, quite a few here for the entities, and then it flows into the individual level provisions. And I think the biggest one is going to be these itemized deductions that we'll spend quite a bit of time on, as well as R&D and already on the last slide. So those are some big items. Let's just jump right in. So for qualified business income, a lot of you are probably familiar with that from the pass-through structure, but it's a 20% deduction for pass-through income that flows through on your K-1 to your owner's return, whether that's an individual trust, et cetera. That provision was set to expire after 2025, and it was subject to certain phase outs and other qualifications. You might be familiar with the term specified service, trade or business, so that has some limitations around it. And it has some other deduction limitations based on taxable income, wages, sort of some of the qualifying assets that might be involved, as well as that SSTV provision. So with that current law, what has changed? The nice part is that this is taxpayer friendly. The deduction remains. It has also been made permanent. So that gives you, I think, a lot more ability to better plan for your entity as well as the owners. It, again, is still subject to certain phase outs and other restrictions, similar with the SSTV classifications. And they did put in a new minimum deduction for certain taxpayers that have maybe a small amount. That's probably not going to be super common for, our IMB clients, but it is there if needed. This is effective for tax years after 2025, because again, that current law was set to expire after 25, so that's correlated there. But just keep in mind again that QBI is really determined first at the entity level for that eligibility, and that passes through to the owners for then their determination and analysis on how they can benefit from that 20% deduction. And a good planning note here is just to really keep in mind for any QBI carry forwards that you might have, whether it's income or loss, both can come into play. If it's loss carry forwards for QBI, that can sort of limit your future benefit of this deduction. So really important to keep high priority in your planning. PTET deductions. So this is what we are calling the pass-through entity tax deductions and/or / elections. So under the current law, this was really something that was put into place because of this individual state and local income tax deduction cap that was set at $10,000. It's very low threshold for individual filers that itemize. The workaround that was sort of created by the states were these deductions at the entity level that require certain elections to be in place for the entity to pay tax on behalf of the owners. Almost every state has implemented this type of structure, and definitely, I think, as well as New York City, maybe one locality has this as well. So this is really important, again, for our pass-through clients and other IMBs, because it really allows you to work around that $10,000 cap, which is very, very low. What's changed? We'll talk more about this in another slide, but at the individual level, that $10,000 cap has now been increased to $40,000. Not much movement there. I think for most people that's in this realm here with the IMB space, it's still going to be very important to understand your PTET elections, planning for those items, timing of elections, payments, how it passes through to your owners, which should be in your box 1 ordinary income item on your K1. So again, continued benefit here as a workaround to maximize those deductions that would otherwise have been limited at the individual level. This looks like it's going to be something through 2029 where we'll have this 40,000 cap. Otherwise, afterwards, it will revert back to the 10,000 cap without, assuming there's no further legislation that passes, but that certainly could change. Just know here that each state really implements these elections very differently. So you really have to understand in the compliance side and the planning side, the timing of elections, as I mentioned, how you make those elections. Some have separate forms. Some require it with a payment to, check a certain box or things like that. So everything is very state specific. So really make sure you consider that in your planning for the year, especially noting that, from the poll question, it sounds like there's a lot more taxpayers that are thinking they'll be in, whether that's book income or hopefully taxable income as well, that this will be an important part of that. The business interest limitation, this was put in place under the current law to basically limit the amount of business interest expense that you're able to deduct, and that's capped at business interest income plus 30% of your adjusted taxable income. And the ATI calculation was previously based on EBITDA through 2021, but after those years, it's just an EBIT calculation. And so it kind of reduced the amount that, increased the amount likelihood that could be limited. And then any excess that was limited would carry forward. So it'd be a timing difference on your tax return. What has changed of the act is that ATI calculation now reverts back to EBITDA, and that has no expiration as of now. And this will be effective for tax years after 2024. So not a huge change, but it certainly is taxpayer friendly in that it should give you a higher base to calculate against which you can take that business interest expense. One note here is that, IMBs typically have, significant interest income. So we don't see a ton of taxpayers that have limitations, but it is certainly possible. So it is something you need to make sure you are considering in your planning, especially if you have significant changes on your balance sheet related to, how leveraged you are, or, new notes, things that have come into play. So really keep that in mind as you look forward to 25 tax planning. So we'll hop here into our next poll question. Again, just a reminder, you do need to complete all 4 to get CPE. This question is, does your business operation include significant time spent on software development? And, this is interesting because it goes back to Tyler's question about, how much of that technology spend do you think you'll have going forward? Sounds like a lot of you are either expecting that to be maybe kind of held the same, but a lot of you also said you expect that to increase, and that can certainly come and impact, this as well. So we'll touch a little bit more in depth on this in the coming slides, but this will give us kind of a foundation to see, for the group, how much, you're expecting to see here for time spent in software development. Let's give everyone another few seconds here. Great. I think we'll move into some responses. So does your business operation expect significant time spent on software development? It's a pretty good mix here, I think. And this is pretty common, I think, as far as what we see amongst IMBs. Some spend a lot more on it. Maybe they're more interested in that tech development. Others might rely on kind of off-the-shelf type products. Really just depends on your needs, but this is definitely going to be helpful as we kind of talk about the next coming slides here for research and development and research and experimental costs. So research and experimental expenses. This was a big change after 2021 under that current law. It basically meant that you could no longer immediately deduct costs related to research and experimental expenditures. You had to capitalize them. If they were domestic costs, that would be amortization over 5 years. To the extent they were foreign, it was a 15-year amortization period. And then, as well, even if you didn't kind of follow through with this particular project, if you disposed of it or abandoned it, you still had to continue that amortization. Another interesting change under the Tax Cuts and Jobs Act was that they specifically included software development here in this definition of what is research and experimental costs. So that really pulled in a lot of taxpayers that previously were just currently deducting those items. So what's changed? The good news is this is taxpayer friendly. Under the Act, they're now allowing that full immediate expensing again for costs related to domestic R&E. So that's effective beginning January 1, 25, which is great news. Foreign will remain the same. That'll kind of continue on as is. And then what they have done is basically put in place for all taxpayers an election that will allow you to look back at those costs that were capitalized for domestic R&E for 22 through 24 and kind of look at what is that unamortized amount left, and would you want to elect to accelerate that remaining balance into 25 and or 25 and 26. So that's going to be a very helpful provision for those that are in taxable income. Maybe now you can help reduce the impact of your tax expense by potentially accelerating these deductions. Another provision they did put in place was for small business taxpayers, but we don't expect to see a lot of IMBs fall into that definition. So I didn't put it on the slide here, but no, it does exist, especially if you have other ancillary businesses. It's certainly something to consider, but it basically allows you to elect to retroactively look back to 22 and see if you would prefer to amend those tax years for 22 through 24 to immediately deduct those costs. But again, we wouldn't expect to see a lot of IMBs really be eligible for that. And whether you pursue what we'll talk about next is the R&D credit or not, just know that Section 174, these R&E expenses, they apply to you regardless of whether you take the R&D credit. So this analysis must be reviewed annually, and it's I would say highly likely that almost every IMB has some costs. Not to say 100%, but it's probably more expected than you might think. So please just keep in mind that to the extent you do have R&E, then the benefit of that R&D credit is going to be that much more valuable to you, because you may have costs that are capitalized here that you can then kind of work around and get some tax benefit with the credit. So we'll touch a little bit more on the R&D credit here. So what is the current law for the R&D credit? This is a permanent credit that is calculated based on your domestic QRE, and that's just qualified research expenditures. That's going to be things like salaries and wages, contractor costs. Those are probably the two biggest buckets that you would see for QREs. Again, the importance of the credit here is that now with the NOL limitations that are in place, because we do know that the last few years have been tough. So if you have NOLs and now you're in income, that credit utilization is going to be more important, because now you're always going to have some component of tax liability potentially, and this will help reduce that impact. For the calculation of the credit itself, I won't go into the details here. That's probably outside of our scope. But when you do have a gross credit, the law does require you to add that back to income. And in the current law, the way that works is it's actually the amount of the credit that exceeds that threshold that you have to add back. So what we're finding is that most of the time, you don't have an add back because you haven't hit that 10% threshold. But if you do, you have an opportunity to make what's called a reduced credit election, or this formal 280C election. And that basically just puts the net benefit of the credit flat at 79%. And oftentimes, that has a better result. If you would have otherwise had an add back to income, the reduced credit kind of gives you a better result overall. But again, under current law, we weren't seeing that really as needed. But now with the Act, sort of what has changed is that calculation of how you determine the amount to be added back to income is now just strictly based on the amount of the credit. So no longer do you have that amount that exceeds 10%. It's just any dollar amount of the credit is technically supposed to be added back to income. So now that formal, 280C election or the reduced credit election seems more likely I think, to come into play here, and that might provide a better result for a lot of taxpayers that have a credit, because you don't have to add that back to income once you make that election. So that's probably the biggest, component for R&D credits, is that that's really focused on domestic, whereas Section 174 for the deduction side is really, can be domestic and foreign, and then you have to consider the interplay, right, between capitalization and deduction and how the credit may benefit you as well. So a really important component for your planning and understanding for 2025 and forward, and certainly with those elections to potentially fix, prior years. You may even have to go and look back and see how you might benefit from those opportunities and or elections for 25 and 26. So these changes are effective for amounts paid or incurred beginning after 24. And I just want to caveat this to say that, a lot of questions we get are around, well, what types of activities really qualify for the credit? And so just to give you a little insight there, we see a lot that could actually come into play. LOS system development is obviously probably number one, but there's a lot that can come into play as well, like, process automation or API development, integration, software programming. I could probably go on to a pretty extensive list, but just know that you might think you don't have R&E or R&D, but it's possible that you do, and so it's worth a conversation if you haven't yet had one with your provider. So an important, I think, area for a lot of IMBs here. So fixed asset expensing, this has been a pretty important area for taxpayers over the last few years, especially because it's had what was 100% depreciation or bonus depreciation. In 2023, that was kind of bumped down to 80% and then was subject to a 20% reduction each year through 2026. So, with costs being high for IMBs, spending was probably a little bit less over the last few years from what we saw from our clients. But it doesn't mean that now that things have maybe slowly started to improve, that maybe you may have more costs that come up for purchases, whether that's, tangible personal property or other real property. This can be a more important and relevant area for you. So what has changed here is that instead of now having this sort of phased out reduction in bonus depreciation, they're now reinstating that 100% amount, which is great, definitely taxpayer friendly. That'll be a permanent change, which is also important. And it's effective for property placed in service after January 19th, 2025. So kind of interesting here, you have this odd window of, January 1 through January 18th, where you're still subject to what would be that reduced bonus amount for a very small window, but hopefully not a lot of taxpayers had significant costs that were incurred during that sort of 2.5 week period. So this will be definitely helpful on a go forward for taxpayers. You also have, for costs that might not be eligible for bonus, you then have Section 179 expensing. And this can help kind of cover those remaining costs that may not have been eligible under bonus. And this has, again, certain thresholds. The deduction was capped at 1.16 under kind of current law, again, subject to those phase outs. But what has changed is now they've bumped up that deduction threshold to 2.5 million. So I think that's a great change. It's almost, more than double. So really taxpayer friendly again. I think a big consideration here as far as federal versus state is just a lot of states don't necessarily conform to the federal treatment. There are a lot that do, but they're definitely, I don't know if it would be 50% or so that don't, but it's definitely up there. So make sure you are planning around the state impacts that you might incur if you have significant costs and you took bonus or 179 expense. And for that matter, if you do have significant real property costs that come into play going forward, a cost segregation study is going to be really helpful for you to understand how to maximize these deductions. And then to that end, if you have real property as well, to the extent you're looking at energy efficiency, you have what's called Section 179D expensing. And that can be kind of an additional helpful deduction as well. But again, not all states conform to these items. So really include this in your annual process for planning and understanding the impacts. So charitable deductions for C corporations, not a lot changed here. I'll try to go through this very quickly. The current law basically just allows that deduction to the extent that the amount does not exceed 10% of your taxable income. What's changed is that they've now put in place a 1% floor. So only contributions above that floor up to that 10% cap are going to be deductible. And that's effective for tax years after 2025. I think this is going to be a really interesting area for our IMBs, especially, but information reporting thresholds. Some of those dollar amounts have changed. So under current law, you're probably very familiar with that $600 threshold for a lot of your 1099 miscellaneous and NEC reporting. That's been in place, gosh, for many, many years. I don't even know how far back that goes. It's been a long, long time. But what has changed is that now they've increased that threshold from 600 to 2,000. So while that seems on the surface to be an added benefit to reduce compliance costs, what we're probably going to see here is not a lot will change. And the reason being is that all that back end work that you have to do to manage your vendors, understand, all the W-9 and W-4 reporting, and get that vendor management system in place, that is all still going to be necessary, whether you have $2 or $10,000 or, $500,000. So, again, the reduction here is probably just on the sheer quantity of 1099s that you'll submit, but not necessarily any reduction in that internal cost that you might have to manage the compliance of all of your vendors and or contractors, et cetera. So these amounts, the $2,000 will be subject to inflation beginning in 2027. So it will continue to increase, certainly helpful, but again, you still have that vendor management process, and that'll still be an important, internal component as you, do your daily operations. This will be effective for payments made after 2025. So this will be 2026 payments that you're filing those 1099s for in, say, January of 2027. We do still see civil penalty notices for IMBs, whether that's related to 1099 specifically or sometimes 1098s, often regarding, missing or incorrect TINs. So again, these have steep penalties. You really do want to make sure that your process to manage your vendors, contractors, et cetera, is sort of rock solid, because it's painful when you get one of those notices, and to remedy it, has added cost. So now we'll kind of jump into more specifically some of those individual topics. A lot of the prior ones that we talked about definitely impact individuals, but they were sort of starting at that entity level and flowing through. These will be more of that true kind of individual level topic components here. So for the individual income tax rates under current law, the brackets themselves had been altered, and there were 7 brackets. You can see there from 10% to 37%. Those were set to expire after 2025, and they would have reverted back to pre-TCJA levels. And the bracket thresholds themselves, as far as the range of income within each bracket, had also been adjusted for inflation. So what has changed? Good news is they made those rates permanent. That's certainly helpful for planning. The brackets, again, will continue to be subject to inflation. And, a lot of those additional brackets will have a little bit of modification there, but we'll jump into excess business loss limitations. So these are pass-through business losses that through 2028 would have been limited at the individual level based on certain calculations for gross income. And from that, those losses, anything that is considered disallowed, basically reverts and becomes an NOL in future years. Basically what that means is that you have an indefinite carry forward, but you're limited to 80% of taxable income as far as utilization in any future year. So, definitely this one hits harder when you have a current year tax loss. We're hoping now, with some of the comments that we saw, from the polls, that, maybe you all are seeing some turnaround there, not only in book income, but hopefully taxable income. So From a current year perspective, hopefully these losses won't be as impactful, but you may have prior year carry forwards that you'll still need to understand those NOL implications. So what has changed? They've just made this limitation permanent. And again, we'll retain those existing treatments for how they carry forward and the utilization on a go-forward basis for the NOL limitations. So that's effective for tax years after 2026. We have a few topics here related to itemized deductions. I think the SALT cap is probably the most important. We touched a little bit on it previously with the PTET deductions and elections, but just kind of to reinforce that current law is set with a cap of $10,000 on your Schedule A. What has changed is that they've now increased that to $40,000, and you'll have some small increases over the next few years, but otherwise it will revert back to $10,000 after 2029 without further legislation. It is still going to be subject to certain phase outs. So it's not even guaranteed that you'll get the full 40, but with the phase out, at least your deduction will never be below $10,000. So again, the importance of those state level PTE elections at your entity level is going to be really important for pass-through entities. Mortgage interest. So this is definitely something that's going to impact you all very much. Qualified residence interest at the individual level, that deduction was limited to the amount related to home acquisition indebtedness up to $750,000. That was set to expire after 25 and would have reverted back to the $1 million you might remember from a few years back. What has changed is that they've just made that $750,000 threshold permanent. So not as taxpayer friendly, but it does give you better, with the permanence, better planning opportunities. As well, for mortgage insurance premiums, you might remember that way back you were able to take some of those as mortgage interest on your individual return. After 2021, those were not considered eligible deductions on Schedule A. But what has changed is that now it will permanently treat mortgage insurance premiums as acquisition indebtedness related to qualified residence interest. So you'll be able to deduct that potentially, based on other thresholds. But I think the important note here is that for IMBs, you'll now have to make sure you're planning for your 1098 reporting to make sure you are properly providing information to those borrowers as far as how much is interest and how much is mortgage insurance premiums. So that'll be effective for tax years beginning after 25. So again, that'll be for 1099s or 1098s, filed in early 2027. So again, important kind of internal planning note here. For charitable deductions at the individual level, pretty similar to the corporate level information, but taxpayers who itemize were able to, take amounts subject to certain limitations. But example, 60% of AGI, you were able to offset that with those amounts of charitable deductions. That 60% ceiling was for cash gifts to 50% charities, and that was slated to expire after 2025. You might normally hear that's 50% charity. That is the common threshold. This was sort of a small change under the Tax Cuts and Jobs Act, and there was no floor here in place for the individual level. So what has changed is that those limitations, for again, those that itemize, is that you'll have charitable contributions will be able to be deducted to the extent they exceed 0.5% of your taxpayer contribution base. That's typically going to be AGI. There could be, other reasons that it might be different, but I think generally speaking, it's going to be an AGI calculation. And then that 60% threshold for, the ceiling on cash gifts, that has been made permanent. So that's definitely a taxpayer-friendly adjustment. And this will be for tax years beginning after 2025. So kind of the last area for itemized deductions is just miscellaneous and overall limitations. The overall limitation on itemized deductions for the last few years, we haven't really had to think about. It wasn't applicable. It was suspended from 2018 to 2025. What has changed is that they've now kind of repealed what was the old limitation that was suspended and put in place now a new 2% reduction that actually has, kind of a calculation around how you might have that additionally limited as well. I won't go into the details, but it's there on the slide for a little highlight. And this will apply to tax years beginning after 2025. So definitely an important planning area, especially if you have significant charitable contributions or other itemized deductions that might, kind of make you fall into this. For the miscellaneous itemized deductions, those were suspended under the current law, kind of similar to the overall limitation. What has changed is that now they've just made those permanently suspended. So no longer do we have any hope for, unreimbursed business expenses or things like that to be able to potentially be deducted, or other items that would have been subject to that 2% limitation. Those really have kind of come off the table, barring any, changes in future legislation. And really the final slide here, as far as what we felt impacted IMBs most, was this estate and gift tax exemption change. So under the current law, gifts made in calendar year 25 were subject to, estates or decedents dying in and gifts made. They were subject to this basic exclusion of almost 14 million. What has changed is that now that threshold has gone up to 15 million. So that's a huge win, I think, for taxpayers overall. Otherwise, it would have reverted back to $5 million. And so I think this is really great to provide a lot more certainty around what estates will have to plan for on a go forward. This will be also indexed for inflation, so it will continue to increase, to that extent over the coming years. And this higher threshold has been made permanent. So again, great news for taxpayers. I think it just, again, provides a lot more certainty for those planning on, changing gifting strategies, implementing trusts or charitable giving. This is going to be a really helpful tool for everyone. So with that, let's hop into our next poll question. This is just related to sort of which provision you anticipate to be most useful. You can certainly select one of the predefined ones here for, R&D or QBI, et cetera. But if you have any other thoughts and want to type one in, please feel free to do so. It just gives us some insight as far as, what IMBs are feeling most relevant and, impactful in their business from day to day. We certainly see that, R&D credits, again, is an area that is sometimes unexpectedly applicable. And so we really encourage you all to ask those questions, have those conversations, see how you might be able to benefit there. And then the PTE deductions is really, really important as well. To the extent you are in taxable income, having that available at the pass-through level is just a great way to maximize those deductions. So let's kind of roll in here to poll results. So R&D credits, certainly some other, but that seems, pretty much with what we would think or expect from the group. So thank you all for sharing. We appreciate that insight. And, if there are any, follow-up items, we will definitely circle back related to those. We will let Nathan here sort of take it away into our final topic here for Fannie Mae updates.
Thanks, Gina. That was a lot of information. I know everybody, but as I mentioned at the beginning of the webinar, you will have access to the slides. If you haven't downloaded them already, go ahead and download them. And then we'll respond to questions after the webinar. We probably will run out of time here today. But if you have any questions, don't ever hesitate to reach out. Wanted to just make you all aware of one more thing that may have not made it to your desk yet or into your inbox, just to make you all aware of some recent changes around cybersecurity that came from Fannie Mae. The CFPB, as we all know, is not very active at the moment. Whether that's a good or a bad thing probably depends on who you ask and the day of the week. But but it certainly isn't stopping Fannie Mae and the states from still being active around regulation. Fannie Mae tends to be the standard setter as it relates to a lot of compliance type functions. And along those lines, Fannie Mae recently rolled out some updates to some cybersecurity requirements that went into effect about a week ago here on August 12th. This really revolves around three main areas that are highlighted here on this slide. One is that any Fannie seller servicer has to have a comprehensive information security program. You can see some of the details of what that program should include. An important thing to note, which is called out in green on the screen there, vulnerability scanning. Also a risk assessment, a cyber technology risk assessment and penetration test need to be done by a third party annually. That needs to happen. If you haven't had it done yet this year, it needs to happen by the end of the year to meet those requirements. The company also needs to have an incident management and notification plan in place that allows for a 36-hour notification to Fannie, and you need to have an incident response plan. You also need to test your business continuity, disaster recovery, resiliency, and that needs to be done, tested annually with tabletop exercises and the like. You can see a couple links there on that slide to some resources where you can pull up some additional details regarding that. But as with all the things that we've covered here on this webinar today, we do have a cybersecurity practice here at the firm with a great team of cybersecurity professionals that are helping a number of our mortgage company clients around the country around cybersecurity. If you have need for pen testing or a cybersecurity risk assessment be done, let us know, and we would certainly be happy to help you. So as we wrap up here, just in summary, we've touched on a few important things here today. We are about out of time, so we'll be responding to questions after the webinar directly to those that submitted them. And reach out anytime. There's a lot to digest from the One Big Beautiful Bill. You reach out anytime if we can be of any assistance to you. Also, just to remind you, there is a recording of this that'll be coming out soon. The CPE certificates will be sent out in the next couple of weeks. We thank you as always for joining the webinars. We hope that the content is relevant and valuable to you. We encourage you to fill out the survey if you haven't done so already and provide feedback to us. We do, in fact, use that feedback to determine the topics that we touch on in these quarterly webinars and in other webinars. And so we appreciate your feedback. And thank you all again for your time and for joining us today, and reach out with any questions or if there's anything we can do to help. Have a great rest of your day and rest of your week. And we'll look forward to being together with you again soon.